Hello and welcome to the Pilot Money Podcast. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies and ARS Private Wealth. Together, we give you the tools and advice you need to take advantage of the ever-changing financial world and help you take care of the business end of your professional aviation career. As financial fiduciaries, we bring you up-to-date, relevant, and independent information so that you can make sound financial decisions for yourself, your family, and your eventual retirement from the airlines. Don't forget to hit the subscribe button so that you can stay up to date on any timely information that we bring to the professional aviation community. Or you can also visit us online at www.pilotmoney.com. Once again, welcome to the Pilot Money Podcast. Hello, everyone. Good morning or good evening, wherever you are in the world today. Thank you for taking the time to join me for this informational video, specifically for those of you that are participating in the VSP2 retirement option that United Airlines gave a couple of years ago and are eligible to receive the CARP benefits from the old Continental Airlines benefit plan. Before we get started, I want to give a special shout out to Janet Rappaport, who is the admin for the CARP Facebook group and has done a phenomenal job in creating an information source for anyone really seeking information about the CARP plan. Together, we talked about what information is most sought after, and we decided that making this video would be a great way to answer a lot of your questions that many of you have about your benefits. But before we get started, for those of you that I have not yet met, my name is Alex Tapia. I'm an accredited investment fiduciary, and I'm also the president and the founder of Aviation Retirement Strategies. We are located here at the George Bush Intercontinental Airport at the private jet terminal here at Atlantic Aviation. So if you happen to be in the Houston area or are living here or just happen to be passing by on a layover, please feel free to stop by. We will pick you up at the terminal if you happen to need a ride as well. Almost exclusively here at Aviation Retirement Strategies, we cater to airline professionals like yourselves, helping you manage your 401ks, making sure that you're using your benefits correctly, and helping you plan for retirement and beyond in terms of creating income strategies from your assets that's also customized to your specific needs and lifestyles. We are an official advisor on your Fidelity 401k plan as well as we are for the pilot retirement account plan at Schwab for the pilots. I've been personally doing this for about 20 years now, and collectively as a group in my company, we manage around $1 billion in assets. So as well as being completely independent, fee-based firm, meaning that we're not tied to any specific investment companies, and we only charge a fee based on assets that we manage for our clients, which means we will do better when our clients do better. This is all part of our fiduciary status in the financial industry. And although we work with all legacy carriers, most of our clients are ex-cons, and the bulk of the assets that we manage come actually from CARP and the CPRP, the Continental Pilot Retirement Plan. So we have quite a bit of real-world experience with your retirement benefits, and the purpose of this video is to educate you on how your plan works and how to apply its options based on current economic conditions. And please keep in mind as we go through this that there is no one-size-fits-all scenario, and everyone's situation is always unique. So I highly encourage you to seek professional advice, even if it's not from us, from a professional certified financial planner that's not trying to sell you something and does not get paid on commissions. As we stated on the announcements, we will be holding 4 separate workshops here at our Houston headquarters for those of you that are interested to talk about how to properly invest your retirement funds and create income strategies based on your unique needs. The dates are yet to be announced, but they're going to be in August. Also, we will be having individual Zoom meetings on a first-come, first-served basis to help you figure out how to set up your individual retirement plan. So if you're interested, please feel free to reach out at this number. In this video, we're going to be covering, we're going to do a brief introduction of what CARP actually is, how you can receive your CARP benefits, taxation of CARP benefits, why annuity payments vary by age, what exactly is a lump sum benefit, and why do the lump sum amounts vary, and also we're going to talk about the pros and the cons of CARP payment options, and more importantly, about CARP benefits and today's economic environment. So let's get started. Okay, so let's get to know CARP. Well, CARP stands for the Continental Airlines Retirement Plan. And CARP is what we in the industry would consider to be an A plan, or more commonly is actually referred to as a pension plan. And pension plans are basically employee retention tools that large companies use to help retain employees for the long term. And in essence, what they do is they provide a guaranteed retirement income benefits to those employees that have served a minimum number of stated years in the company. And in the case of CARP, it is a minimum of 5 years for vesting and then it's also a maximum of 30 years for benefit accrual purposes. Now, to receive benefits under the plan, you also have to meet certain eligibility requirements, which are, first of all, you have to be a common law employee who works in the work category of union represented employees who are covered by a collective bargaining agreement that requires participation in this plan. Basically, that's 99.9% of all of you. And also, number two, you have to have completed at least 1 year of service with the company, which obviously all of you have. Now, although each plan is a little bit different, all pension plans use a formula to calculate how much of a benefit an employee is entitled to upon retirement, or what we call separation from the company. CARP is really no different. However, although the calculation methods have changed a little bit over time, specifically in 1999, what's actually important moving forward is the formula that it currently uses, as the past formulas really have no relevance on any calculation of your benefits today. So let's talk about the formula that the plan uses. But before we go into that, let's keep in mind that this formula tends to give people a lot of headaches, and it's not really necessary for you to know this formula or actually even use it for yourself and try to get all the data that it needs in order to get the number right for yourself, because you can go on your benefits resources online, and they actually have a very good calculator that helps you figure out what your benefit is going to be depending on the parameters that they ask you to put into it. And if you need any help, feel free to reach out to us. We're able to go on with you and your benefits resources. You can either call them or do it online together, and we're happy to help you out. But for the most part, the formula that the plan uses consists of basically three elements. And the first element is your final average compensation. And it takes into account basically your regular pay, which includes your before-tax 401k contributions, your before-tax contributions for all regular or flexible benefit plans, shift differentials, gain sharing, and after 1998, also overtime pay. It will then calculate the average of the highest 5 years of the last 10 years that you've been in service, with a cap on any calendar year of $170,000. There's a couple of other stipulations that they use for this part, but it depends on your hire date and as well as whether or not you have 5 consecutive years or not. And again, if you need any help, feel free to give us a call, and we're happy to help you walk through it, or you can go to your benefits resources and try to figure it out there. We can help you apply the actual numbers to your specific situation. So the second element is your benefit service credited to you specifically, as outlined earlier. Basically, it has to do with how many years credit you have received. And for all you senior folks out there, keep in mind that the maximum credit that you're going to receive is only 30 years. The third element, and this is where people kind of get confused a lot, is the Social Security wage base. So each year, Social Security sets a level of wage dollars above which it does not collect tax for future benefits. This is known as the Social Security wage base. It's the maximum amount of eligible compensation on which you and United Airlines paid or will pay income replacement Social Security taxes each year. For 2022, that amount is $147,000. So the plan uses the average Social Security wage base to calculate your benefit. This is the average of the Social Security wage base for the 35-year period that ends the year before the year you reach the Social Security normal retirement age, which is 65 through 67, depending on the year that you were born. So now that we have all the elements of the formula the plan uses to calculate your benefits, we can plug them into the formula like this. They take 1.19% of your average compensation, then add 0.45% of the final average compensation in excess of the average Social Security wage base, multiply by your years of service up to the maximum of 30 years, and then divide that by 12. And then you have your monthly benefit amount. Simple, right? Not really. However, if you think about it, if you want to know what your benefit is, you can also, like I said earlier, go online to your benefits resources, and they have a calculator that can tell you what your benefit is. However, one of the constantly changing variables that you'll see in terms of the lump sum are interest rates, and we're going to talk about that in a few minutes. Either way, if you have any questions about this stuff, give us a call. We're happy to help you figure it out. Let's talk about the normal retirement age, because a lot of you have questions about sometimes these numbers can tend to be a little bit confusing. So as you probably already know, the normal retirement age for CARP is 65 years old. However, many of you asked, why does the monthly amount change if you retire early? Well, with CARP, the plan documents allow you to retire early if you are at least 50 years old and have at least 20 years worth of vesting service, or you're at least 55 years old and have at least 10 years of vesting service. However, you might have noticed that when you retire before the age of 65, you're going to receive a lower monthly amount. So for many on the surface, this seems like not really that great of a deal, but it's always important, as with any financial decision, to follow the math all the way through. So let me try to explain. For some reason, actuaries, these are the people who calculate all this stuff out for you, know for some reason when you're going to die. And they actually have a little chart that tells them that your life longevity. So basically, here's how it works. So let's say that your benefit that you are entitled to at 65 is $2,000 per month. And the actuaries have calculated that your actuarial death age is 85. Well, mathematically, if it all works out according to the actuaries and the actuarial tables, you will receive a total of $480,000 over the course of 20 years. However, should you choose to retire early, let's say at 55, you will still be getting the same amount of money, but you're going to be getting it for a longer period of time. So your benefit has to be reduced to compensate for the larger number of payments. In this example, your payment would be reduced to $1,333 per month, which equals to the same $480, but over a 30-year time frame. So leaving early is not really penalizing you. The plan will still give you the same amount of money, but simply for a longer period of time. Okay, let's talk about taxation on CARP benefits. CARP is considered to be a qualified plan according to the IRS. So this simply refers to the types of money that exist in this world. Basically, in the financial world, there's only two types of money available there, and they're either qualified or they're non-qualified. Qualified money is money that qualifies under the IRS tax code to be treated tax favorably. This means that any accrual of this type of money is tax deferred. You don't pay taxes on it as it grows, but pay them once you start personally receiving them. These types of money are taxed at your ordinary income tax rate, and the IRS is very, very diligent about keeping track of these funds for you so that they can be sure to collect the taxes due on them as you use them. All other monies that are already taxed and distributed to you are considered non-qualified. This is your paycheck or any other money that's already been taxed. These are monies that the IRS does not care about because they have already collected their taxes on them. In our world, we're actually not even allowed to combine qualified and non-qualified monies for IRS tracking reasons. So, since CARP money is qualified, you will be taxed on any distribution that you take from the CARP at retirement because it has been deferring those taxes as you have been accruing your benefits. Oftentimes, this is when the mistakes are made, even by professionals, by not properly setting up the receiving accounts and unnecessarily creating a huge tax bill for retirees, especially when they take the lump sum. It's crucial to talk to a competent professional, and if you need some guidance from us on this, please give us a call because this is one mistake that you do not want to make. So now that we've kind of discussed taxation on distribution options, let's talk about what the distributions options actually are. So the first one is probably the most basic in its form, and it's called a lifetime payment. Like any other annuity, the benefits that CARP offers are all based on you taking a lifetime payment option. This is what is technically referred to as an annuity. A lifetime set of income stream that ends the day that you die. It's calculated based on the monthly payment amount earned per the formulas that we talked about earlier that you can go look at on Your Benefits resources to calculate what your payments actually are. There are other options of taking this annuity, and that comes into play if you want another person to also be paid by the plan over their lifetime. These are called survivorship options. These options basically reduce your payment, but they are then spread out over 2 lifetimes, and this usually includes your spouse or your partner. Once you make an election, though, it's irrevocable, so should you choose a lifetime annuity of any kind, please be sure that you think through it carefully and ideally with a competent financial planner who has a true fiduciary status. Again, if you need help, we're always available to help you make these types of decisions because they're extremely important, and once they're made, you cannot take them back. One of the more popular payment options from the CARP is the one-time lump sum payment. Now, a lump sum payment is basically a present-day value of the stream of monthly annuity payments that you could expect to receive during your retirement. You're qualified for it at the age of 50 with at least 20 years of vesting service, at age 55 with at least 10 years of vesting service, and also at age 65. The amount of your lump sum will be determined by a lot of factors, and they include the amount of your monthly annuity benefit, your age when you collect it, and the assumptions set by the Internal Revenue Service. The assumptions made by the IRS include an annual mortality table, which is used to estimate your remaining lifetime, as well as a segmented interest rate to convert your annuity payments that will be paid into the future into present-day value lump sum. Did you get that? Yeah, no one else did either. So let's simplify that and what it means in the real world. Well, basically, your CARP benefit actually has nothing to do with a lump sum. It is simply an option that was negotiated into the plan, and it's actually very beneficial for multiple reasons, which we're going to get into a little bit later. But let's go back to our previous example of our lifetime payment of $2,000 per month, or $24,000 per year, or $480,000 over a period of 20 years. For now, we'll just assume that this is our situation. So how is a lump sum derived from that? Well, pension plans have very strict rules, and companies that offer them have to be very, very careful about making sure that the funds are available when their employees retire. There are some serious financial consequences if they don't. This means that in our case, when we retire with our example, the company should have $480,000 available for us to be able to pay our monthly amount for a period of 20 years. However, because the company's responsibility is only to make sure that they can make the monthly payment, the Employee Benefits Security Administration of the Department of Labor, these are the folks that regulate pension funds, allow them to use an investment so that they can invest a certain amount of money that, based on a given interest rate, will produce a total of, in our case, $480,000. The interest rate that they can use is derived from the composite corporate bond rate. It is published by the IRS on a monthly basis. So being able to invest the funds with a certain amount of interest rate return, the company actually does not have to come up with a full amount the day that you retire, but simply the amount needed to accumulate up to $480,000 over a 20-year period using the current interest rate that was in effect when you retired. The CARP plan documents allow for whatever that amount was that the company had to come up with to make it available to you in the form of one lump sum payment, hence the lump sum option. The theory is that the company will go out and purchase an annuity for you. So if they have to do that anyway, why not just let you do that on your own and maybe even comparison shop or maybe make an investment out of it? It's a nice option to have and is not very common amongst other pension plans. Why does the lump sum vary then with interest rates? Well, if you think about it in our example, if interest rates are low, the money that the company is required to invest to be able to achieve $480,000 worth of payments over a 20-year period is higher than it would be if the interest rates were higher, because they're not going to get the same return on the investment. When the interest rates are high, the company has to come up with a lesser amount to get the required funds for our scenario. CARP looks at these interest rates twice a year. Once in February, which applies to any lump sums paid out from July 1 through November 30th, and once in August, which applies to any lump sums paid out during December 1 through June 30th. So for those of you that are coming up with the benefit commencement date of September 1st, you will be subject to last February's interest rate. Quite often, there's been times where we run into scenarios where retiring employees think that they have to take their benefit right away. However, a lot of people don't know that the plan actually allows you to wait to take your benefit. During the past several years, there have been a few times that we've actually recommended clients to wait if we're pretty certain that doing so will be to their benefit. If they're taking a lump sum and interest rates during the next calculation window are expected to be lower, it may behoove someone to wait. However, this is a very dynamic world and things are changing rapidly, so let's talk about interest rates and let's talk about the real world. Interest rates have been around forever. Ever since the first caveman lent a rock to another caveman and charged him an extra rock as interest, interest rates have pretty much always had the same pattern of about 30 to 40 year cycles from peak to trough. Some of you might remember that the early 80s when you had high inflation. Well, if you fast forward to say last year, we were in the trough of that same cycle, and it is right on schedule to start going up. Now, unfortunately, due to government policy decisions in the last year, inflation is very high right now, but that should stabilize at some point. However, during the regular course of long-term interest rate cycles, unfortunately, we will be in a rising interest rate environment for the next 2 to 3 decades. This means that if taking a lump sum is your option of choice, the earlier you take it, the better it's probably going to be, if you only look at our interest rate environment. Now, remember that the higher the interest rates, the lower your lump sum will be. So it's important to make the right decision based on what's going on in today's current environment. If you have any questions on that, please give us a call. We'll help you talk through it. So let's talk about the pros and cons of the two primary options that CARP provides. It's either a lifetime annuity or it's a lump sum payment. Now, the lifetime annuity is literally a payment of a fixed amount that gets paid over time over the lifetime of an annuitant, which is the person that receives the payment. There's many folks that find such programs attractive due to the stability and the predictability of the payment. It's easy to budget, and along with Social Security, can make a very decent income stream for someone. The problem becomes that receiving your full benefit relies on certain unknowns. Primarily is your life longevity. Using the straight life annuity, if you do not live as long as the actuarial table says that you should, you will not get your entire benefit. And as with all straight life annuities, the annuity company will keep the remaining money after the annuitant dies. This is why there's also survivorship options that the plan offers. They reduce the monthly amount of money that you will receive. This is when it becomes crucial to consult with a competent financial planner to look at your situation in a holistic fashion. Interest rates are a key factor in deciding whether or not to take an annuity. As I mentioned earlier, interest rates more than likely will be going up from this point, which basically means inflation. Since an annuity payment is fixed for your lifetime, inflation will devalue that amount over time. What's happening now is a perfect example of that concept. Having a lump sum option is a great option to have during times like these because it gives you literally all the flexibility that you need. It allows you to invest your funds, which gives you the best statistical probability to at least keep up with inflation. However, receiving such a large chunk of money could be intimidating to many folks and requires experience to deploy these funds into the equity markets in the right way. However, once the money is in your name, there's countless options that you can do, and it's simply a matter of figuring out what is best for you individually. I think one of the best reasons to take a lump is the fact that you're able to pass it along after death, as opposed to letting some insurance company keep what's left over. So let's compare the pros and cons of each type. First of all, let's talk about the annuity. Well, the pros of the annuity, number one, it's predictable. It could provide you a good income if combined with Social Security. But the negative of that annuity is basically that it's a fixed payment is reduced by inflation, and it really has no investment options, and more importantly, it's non-transferable. However, on the other hand, the lump sum, some of the pros are you have the ability to shop for investments. The money is in your name. You can assign a beneficiary, and it's got the best chance of keeping up with inflation if it's invested correctly. Now, some of the cons for a lump sum is basically it's taxed unless it goes into an IRA, and that usually requires a professional if it's invested. And it's also subject to market fluctuations, which some people have a hard time dealing with. So now that we've covered a lot of the important things about CARP, there's a lot to it. And if you want to learn more about it, I mean, there's documentation out there. You feel free to give me a call. Happy to talk to you about some of the other details that we really haven't discussed. I've just kind of covered the more important ones, and also more importantly, some of the questions that we get asked the most by folks that are looking to retire from United Airlines. But I want to finish off the video by talking a little bit about real world and about making the decisions. And I think that making the decision to retire is a life-changing event, and it's important to retire for the right reasons. Although much of the time the concentration is on CARP, or if you're a pilot on the CPRP, the Continental Pilot Retirement Plan, the reality is that CARP is simply a tool to enhance your retirement. At the end of the day, your financial life is as unique as your fingerprint, and you should treat it that way. For most of you, along with your 401ks, you are very, very wealthy when compared to the average American. This means that you have more options than most, so it simply becomes about finding the ones that are right for you specifically, which is why it's so important to find somebody that's willing to educate you on what they are. Take the time to find individuals like these. They're out there. Be aware of those trying to sell you life insurance or as an investment or expensive annuities, because usually those folks are more motivated by commissions than they are about your well-being. It's not to say that these types of products are bad. It's just that they have to be used for the right reasons, as is with any investment. Also, try not to follow the herd. What's good for one person is not necessarily good for another. Remember that once you step off the plane, your life is completely different than anyone else's. What your best friend did with their retirement is not necessarily what you should do. This is a very complicated world, and this industry is genius at trying to confuse the everyday investor. A good financial planner should be able to educate you on all the options that are out there so that you can make an educated decision, an intelligent choice on what is best for you and your family, because that is the only thing that matters. If you would like some help or have any questions, you're welcome to give us a call. We have nothing to sell you or have any ulterior motive in mind. As fiduciaries, we are required to provide you with all the options that are available so that you can make the best decision for yourself and your family. If you'd like to learn more about our planning process, it is extremely comprehensive and is more importantly, it's completely customized to you and your family, but best of all, it comes at no charge or commitment from you. We can help you create the peace of mind that you need before embarking on this new chapter. I'm going to leave our contact information at the end of this video, but I want to thank you for listening to us. I want to thank you for your time. We're looking forward to speaking with you. Congratulations on your upcoming retirement. If there's anything that we can do for you, we're always around. Thanks again for listening. Thank you, Janet, for allowing this video on your group. And we're looking forward to hearing from everyone. Thanks so much. Once again, my name is Alex Tapia. I'm the president and founder of Aviation Retirement Strategies. Have a great day. We'll talk to you soon.